Hey, what's up guys? Note Investor here. I'm going to be doing a unique video, not my normal market analysis updates or technical analysis training, but this is in response to a few questions I've had recently regarding gold and silver and other precious metals. How are the ways to trade it and invest in it? What are the various options, the approaches that I take? As many of you guys know, I do follow multiple markets. Gold and silver was actually one of the first trading markets that I learned in, and I've had some experience with this in the past, whether it's investing in physical bullion or trading commodity options and futures, as well as ETFs and stocks. And so I still keep track of this space. I do take the occasional trade in this, certainly not daily or as active as I used to be, but I absolutely follow the space. And so the intention of this video is really to introduce you to some of the key concepts, some of the main ideas, and just provide some ideas and concepts that you can from there go on and explore further, do some more research. This is in absolutely no way an invitation or recommendation to buy or trade, invest in gold or silver or any related items that I do talk about in this video, but I do want it to be educational. It's kind of a how to get started type of video, and so I hope this helps. Without further ado, let's get to it. And so the four major categories that I will be talking about here: physical metals, futures and options, ETFs, exchange traded funds, and then the miners or the actual gold, silver mining company stocks. And of course, there is much more to it than this. This is not intended to be an exhaustive list of research and options in which you can invest or buy in gold and silver, but it's going to be a little bit of a primer. And in all fairness, it's a little bit US centric, so a little bit caters to the US investor, but gold is absolutely an international commodity. And so there are many ways very similar to what I'm going to explain that will be readily accessible for just about everybody, depending on which part of the world you're in. So I'm not just going to cover slides here. I'm going to certainly show some charts and graphs and all that good stuff. But for now, just going to cover the basics very quickly to provide some context, and then we'll get to it. So gold and silver trade around the clock, many days a week, 6 days. So for those of you that are familiar with the Forex markets, my time here in the US, they start late Sunday afternoon and then they close going into Friday, and gold spot prices trade the same way. So they do trade 24/7 on the futures exchanges. And in my opinion, this is of course my opinion, gold, while it is a commodity, trades more like a currency, meaning it's not as susceptible to things like supply and demand issues and all that stuff, much like oil would be, or corn or wheat or something like that. And you'll see here when I show the charts that it really follows the currency fluctuations much more. And I've always looked at gold as just a core currency, right? The anti-dollar or the euro or something like that. And that's really what it tracks to. There is some seasonality, and absolutely it is a commodity, and there's some factors there. Silver more than gold, but in my opinion, gold is a little bit more of a currency than a commodity. And it reacts strongly to economic news, interest rates, inflation outlooks, and of course currency fluctuations, as we'll see here when we look at the charts. Gold is priced in troy ounces and in kilos, depending on where you are and which part of the world you're buying it. It's actually referred to as the spot price versus what you may see on the contract price for, say, a futures option or something. And so generally, if you're looking to, say, for example, go buy a gold coin, they're going to sell you generally some sort of ounce or half ounce or something like that, and it'll be priced on spot price plus some premium. And as I record this, gold trades for around $1,300 US as of now, and silver trades for around $14 US. So first things first, precious metals, the physical metal itself. I'm going to very quickly cover this. This is not really the main core topic. I'm going to really cover more of the trading aspect, but many people believe that you should start off buying physical bullion itself, the actual gold coins or gold bars, if you will. And there's some pros and cons to that. Generally, you're going to buy bullion directly from some sort of bullion dealer, whether it's online or one of your local dealers. The pros are it's in your possession, right? And a lot of people are believers that, hey, if it's not in your hands, if you don't control it, it's not really yours. There's some counterparty risk. Maybe the preppers or kind of the economic collapse type of folks will absolutely want to have physical metal in their possession, and I can see that point of view. It's also fun to look at, to be honest. I mean, if you've ever held some gold coins in your hand, it's pretty cool. It's private, of course. It could remain anonymous if it's physically held in your possession, and it's portable, right? Obviously to a limit because it's metal, it's heavy, so you're not going to necessarily be wanting to transport large quantities, but you know, if you wanted to carry around a pretty decent amount, I mean, gold is dense, so you could certainly carry a few coins in your pocket if you wanted to. The cons, of course, there's low liquidity. I mean, you're going to need a dealer from which to buy it and from which to sell it back, or you're going to have to find somebody locally to buy it from you. There's high premiums associated with that, both on the buy side and the sell side. And of course, there's storage concerns. Where are you going to put it? Where are you going to store it? And security issues. What if somebody knows about it? What if they want to steal it from you? Or if you go to try to sell it to a stranger, there's some risks there as well. And of course, lately we've also been seeing counterparty, counterfeit risks in terms of counterfeit bullion. And so there's certainly some pros and cons there from buying the actual physical metals themselves. If you do go down this path, do some research, but the biggest takeaway I would say is focus on buying only high quality bullion, such as, you know, the American gold eagles, the Canadian maples, South African Krugerrands. You could look at the Chinese pandas, that sort of thing. Stay away from the overpriced numismatics, the collectibles, the rare coins. They're just going to be very overpriced. Rarely are you going to get a good return on your investment in something like that. If you're focusing on the metals, look at them as what's the most bang for my buck? How much metal can I get for my dollar? To a point, you don't want to go too cheap because it's much easier to sell, say, an eagle or a maple than it is to sell what they call junk coins, junk bullion, just some random printed coin. A few sites to look into if you're interested in going down this path is APMEX, an online dealer, as well as Kitco. Also, you can buy from them, but they also have information, charts, prices, all that sort of thing. So kitco.com, apmex.com, and then of course your local dealers. And next, before we get to the charts, futures and options. Generally, I would recommend newer traders shy away from this space because while there is great potential in trading futures and options on futures, there is huge risk as well, and it's not suitable for beginners. These are great for short-term trading. Again, it's leveraged, and so you can certainly make out nicely if you know what you're doing, but I would really recommend just doing a lot more research, trading it small. You can trade micro contracts, that sort of thing, but just not a good place to start. Generally, I would recommend looking at the next two options that I'm going to talk about if you're looking to do a little bit more active trading, and then of course when you're more comfortable you can move into larger positions with futures and options. And you can also trade the XAU pairs, which is basically gold pairs, on some of the Forex platforms. Many Forex traders will also look at gold as one of the pairs that they trade against, and so that's the XAU generally on those Forex platforms if you're interested in that. But if you do want to learn more about the future side, check out the CME Group site. They will have the futures contracts, the settlement dates, the current prices for each of the contracts. You can also find the options informations and all that stuff. And generally those that are interested in trading this aspect of gold and silver will look at things like the commitment of traders report, the open interest, the net long shorts, depending on if it's the specs or the majors, that sort of thing. So just it can get pretty complicated going down this path, but certainly there's a lot of good information and can be lucrative if you're willing to put in the time to learn about it and do a little bit more research. Next up on the list are gold and silver ETFs. Now this is generally where I'll put my focus on between the gold and silver ETFs and then the mining shares themselves is where I'm going to spend a little bit more time here on this video. We'll look at some charts, but this is where I would recommend exploring if you're looking to do a little bit more active trading and investing in this space. The ETFs are a nice alternative to getting exposure to the precious metals without actually having to take delivery. Of course, for those of you that are counterparty risk averse and kind of looking at that economic collapse scenario, that sort of thing, you're not going to want this. But for most people that are just looking to profit from the fluctuations in the price, this is a good place to start looking at it. They're very liquid and very accessible for most traders. Generally, you can buy these from just about any popular brokerage platform that you would use to buy stocks or options. The two most popular ones here for gold and silver, the GLD ETF and then the SLV also. Now the GLD is about 1/10 of an ounce of gold, so one share of the GLD is going to be a fraction of the price of gold, and then the SLV is almost a 1-for-1, so it's basically the equivalent of buying 1 ounce of silver when you buy the SLV. The nice thing about these is that they are both optionable, meaning you can buy put options, call options on these ETFs. And so it's a nice way to leverage the movement. So if you're looking for a movement in a certain direction in gold or silver, you can play that. A lot of times you may do some more advanced options on these. So if prices are getting very narrow, perhaps you'll do a straddle or some sort of multi-option type of play on these ETFs. And so there's a lot of ways you can approach that, but it's kind of nice that they do have that option for these two ETFs. There's other ETFs to consider, the IAU, the SGOL, the BAR, and again, just depends on what you're looking for, the different parts of the world you're in, but these are all accessible. And then of course there's leveraged ETFs that come with these, the UGLD, the DDGLD, which is, if you're looking to go long or short, USLV, the AGQ, or the ZSL for shorting silver. However, I will note that for leveraged plays, generally I will prefer playing the miners, which we'll get to here shortly, or options on the GLD or the SLV themselves. Let's take a look at the charts of these items to see how they compare to gold spot prices, to the US dollar as well. So here I have TradingView, and what I've done is I pulled up gold itself. This is just tracking the gold spot price. So if you type in gold under all, you can see here it does CFD TVC. That's going to be the gold spot price here. And if you type that in, you can see this is basically the price of gold movements. This is the 1 hour chart as at this point. And you can see right here it's trading at basically 1301. And if you look at the daily chart, it's been in a little bit of an uptrend since the second half of last year, moving nicely. And in the big picture, the price of gold is actually forming a very interesting pattern here, potentially looking to break out from this very long multi-year consolidation that it's been in. And you can see there's been a strong resistance level here forming, which at this point is now sitting right around that 1350 level. If we can begin to clear that 1350, 1400 level, then I'm looking at gold going on a potential nice little run here, 1400s, 1500s, who knows how far it'll go. Again, this is a little bit more longer term. We're looking at the weekly chart, but certainly along the way, there will be some opportunities. You can see that since the lows here in August, prices have risen about 14%, and the miners, many of them, much more than that. Now, gold is seasonal, and generally July, August is when we do see a little bit of a pause and a bottom, and then a rally going into the springtime, which we are in now. But it doesn't happen every year, but there is some seasonality aspect to it. So gold here, now if we compare that to the GLD, the gold trust, the gold ETF, you can see very similar price action, but look at the price here. It says 123 basically as opposed to the 1300, so you can see there's a fraction difference there in terms of the actual price. Also, because this is an exchange traded fund, it's only going to trade during the open market hours, and so there's going to be gaps in the price versus the futures contracts, which won't have those gaps because they're fluid, they trade 24/7. This one's going to have these gaps depending on what gold did overnight by the time this one closed and opened the next day for trading. And so just something to make note of, but generally in the big picture, it's going to be pretty close. It's going to track to the same price movements that gold will. And so if we compare these two side by side, one could easily see that they do track each other pretty closely in price here. On the left is the GLD. You can see since July, the drop, the bottom here, the most recent rally, and then here on the right is the gold spot prices themselves. A little bit much more clean look and much more fluid, but again, tracking pretty much to the same price movements. The same goes with silver. So we type in the SLV here on the left, that's the silver iShares ETF, and on the right you can look at the silver spot prices themselves. And you can see here the silver ETF right now priced at about $14.50 versus silver spot prices trading right around $15.40, so about $1 off. But again, the main takeaway here is they do track pretty closely to each other. You can see the recent drop here, this low around $13 in the most recent rally, and vice versa here on the spot prices themselves. So those are good options, alternatives to the actual physical metal, the GLD and the SLV for gold and silver. Now, before we move on to the mining shares and the ETFs that I like to trade there, I want to point out the view that I was talking about with regards to gold and the currency relationships that we generally will see. So if I put in gold here again, and over here we look at something like the US dollar index, you can type in the Dixie, the DXY is a good index for that. And if we look at these stacked on top of each other, you can see there is an inverse correlation to the price movement of gold versus the US dollar. Here on the bottom is the US dollar index. You can see when this was dropping, the price of gold was rallying here. They paused in April to about August, price of gold dropped. April till about August, the US dollar was rising, and so forth. And you can see there's, of course, not a perfect correlation, but very often there is this inverse correlation. And so many times what I will do is when I'm trading some of these movements, I'll look at this dollar index to see if potentially it's topping out or bottoming out, and that may have an impact on the price of gold. I will also look at the euro, because the euro has a large component. The euro and the yen are large components of this US dollar index, and so very often gold and euro or gold and yen will trade very closely together. And so just something to look into, especially if you're familiar with the Forex space. Keep that in mind, and generally people that trade the Forex markets will note that gold does have some correlation to the currency pairs, and it will trade more like a currency than a commodity, meaning it'll react a lot more to things like economic outlooks and recessions and inflations, as opposed to, you know, there's this large supply of gold coming in or something like that, because it's generally not. It's pretty stable. The supply space and the supply outlook is not necessarily growing by leaps and bounds. There's not this huge demand or industrial demand that's driving the gold consumption or anything like that. Again, it's generally a reserve, and so a lot of foreign banks will use gold as reserve currency, and such it trades like a currency. So just wanted to make note of that before we move on to the mining shares. And so last but not least, the gold and silver miners, and I'll cover these quickly. Again, we'll look at some charts, and then I'll go over some examples of some recent trades that I did, some movement that we saw here and how it impacted gold and silver. And it was really related to the FOMC, the Fed meeting here in the US, the last one, and some of the minutes that were released impacted some of the currency markets and as well as the gold market. So we'll take a look at that. But first off, looking at the gold and silver miners. Now the miners are essentially those companies that are gold producers. They're out exploring gold, silver, and generally gold and silver are just not in isolation. Many of these companies are also involved with copper and zinc and nickel and some other metals, and often gold and silver may be byproducts of some of those other mining operations. And so it's a little bit more complicated than just a pure gold and silver miner, but the price of gold generally will impact these miners with leverage. And the reason for that is the mining cost for these companies is generally fixed. There is some minimum amount of price that needs to be had for gold mining to be profitable, but above that, every tick that the price of gold or silver will go up is just inflating the margins that these companies will have, because they're looking for some sort of fixed cost in terms of mining operation. And if they're able to sell gold at a higher price, then that's just extra profit, extra margin. And because of that, you will generally see a leveraged move up. So if the price of gold runs 10%, very often the mining shares will move up much more than 10%. It's usually going to leverage that. So, and the same thing goes on the way down. If the price of gold or silver drop, oftentimes the mining shares will drop on a higher percentage basis. It's important to note that each of these companies, I mean, they generally have mining operations all around the world, and so they're susceptible to geopolitical risks. There's company-specific issues. Perhaps there's an accident in one of the mines or some sort of environmental concerns, that sort of thing. And so there are certainly a lot of idiosyncratic risks with each of the specific companies. And because of that, I will generally prefer baskets of mining companies, mining shares, versus buying the individual miners. Now, when I first got started, I was generally doing a lot of research, buying individual names, looking for those big takeover projects and the big movers and all that stuff, and the explorers that were about to launch a new mine. At the end of the day, it was a lot of work for a lot of risks. So I decided against it generally. And now, I mean, I do maintain a list, a watch list, which I'll show you here shortly, of mining shares that I'll track. But generally, when it comes to my own personal investments or trading, I'll stick to the ETFs and I'll try to get those baskets of mining shares. And so the first couple that I would recommend here to look at are the GDX, the gold miners, and the GDXJ, which is the junior miners. And so the gold miners are going to be the established names like Barrick Gold or Newmont Mining. And then the juniors are going to be some of the smaller cap, younger companies, smaller operations. The same goes with the silver miners, the SIL and the SILJ, the SILJ. There's two that I want to point out that are a little bit different. Wheaton Precious Metals and Royal Gold here. And these are really what they call streaming companies. Do some more research on these, but these are pretty interesting business models in which they don't actually manage any mines themselves, but they've bought the rights to certain metals, and so they're also nice leverage plays with lower risk. So when it comes to individual names, these are two that I will look at if I want to buy an individual name. So Wheaton Precious Metals or RGLD. Some leveraged plays which I will use for day trading, the Nugget and the Dust. Now caution, these are 3x leverage plays on the GDX. You can also get them for the silver or the gold junior miners, but generally I'll look at the Nugget and the Dust. Looking at these here, basically what the way they work is the GDX is the basket of gold miners and the Nugget is 3 times leverage on the GDX. So let's go look at the charts there. And so with all of these ETFs, I would recommend do the research on them, pull them up, go to their website, and you can see a lot of information about the fund, how much assets they have in total values, the daily trading volume. You generally want some good liquidity in all of these, so look for those that have higher liquidity. And you can also see their holdings, right? What are they holding? What percentage of the total funds are in that name? And so here, for example, the GDX, Barrick Gold, Newmont, Franco-Nevada, Newcrest Mining, Wheaton Precious Metals, Agnico Eagle, and so forth. And you can see these top few names are going to generally drive the movement of the GDX versus some of these smaller names here at the lower end of the scale, Hecla Mining, First Majestic Silver, that sort of thing. Same goes for the GDXJ. You can see what's in there. And so do some research on these. It's certainly interesting to see how they allocate their portfolio, but this is also a nice way to do some research if you were interested in just buying the individual names. This is a good place to start for a list of those mining names and information about them, such as where they're located and that sort of thing. So going back to the charts here, you can see here on the screen, I have the GDX on the screen. Now the GDX again is the gold miners ETF. That's different from the GLD, which is the gold ETF itself. And so if we compare the two here, we can see that there is some correlation, but there's also a little bit of leverage going on here. And so on the screen is the GDX here on the left, and then the GLD here on the right. And so this is going back April of 2018. And so if we go back April of 2018 here, one thing I want to point out is the size of the movement here. You can see generally it's going to follow the same pattern, right? The GDX here had this drop, then it bottomed out here, and then it started to rally, and that's because the price of gold had dropped, had bottomed out, and also started to rally. But if we compare the size of the move for the two, you can see here the GDX from the low that we most recently saw in September to the high that was placed here recently, that was about a 36.7% move. You compare that to the movement in gold during that same time frame, the price of gold moved 14%. And so you can see how much more the GDX outperformed the price of gold on the way up, and that's because of that leverage aspect that I was talking about. The miners will generally do very well if the price of gold moves and leverage the move, but the same is true for the downside. If the price of gold drops significantly, these are going to drop much more. So you can see that drop we saw last summer, the GDX fell about 24% as the price of gold fell about 10%. And so certainly there's the leverage that cuts both ways, but it's a nice way to leverage the move with less risk than buying the individual names themselves. If you wanted to do that, you certainly are putting giving up a little profit potential if one of the individual names will pop, but this is a nice way to do it. Now let's compare the GDX to the Nugget, which adds an extra layer of leverage component to that here. And so remember, the Nugget is 3 times leverage on what the GDX is doing. Now I personally don't hold something like the Nugget for long term because of many reasons. There's slippage, there's some fees involved with that, so it's not something I would hold for months at a time. And generally I use the Nugget for day trading or swing trading, and I'll use something like the GDX or the SILJ for a little bit more longer term holds. But that's my personal preference. Certainly you might want to do some research on that and compare the two. But what I want to point out is the leverage again. So the GDX here, peak to peak, moved about 36%. During that time frame, the Nugget peak to peak moved 126%. So again, much bigger move on a percentage basis because of that leverage component. So the Nugget, and then the inverse of that is the Dust. And so that's if you want to short the gold miners, you will do something like the Dust, which gives you that inverse move. So if the price went up on the miners, and of course the Dust is going to drop, and vice versa here. When the miners were dropping off, the Dust was a very nice trade, went up about 100%. in just a couple of months here as the gold miners were dropping. So the nugget and the dust are two that I like to use, but again, a little bit more intraday or swing trading for some leverage aspect of the gold price. But I will certainly base everything off of the actual gold and silver spot prices themselves. I'm not just trading these in isolation, in silos. I'm generally looking at what's the gold silver price doing itself, and then I trade these vehicles in conjunction with that. A few more we'll look at here. So the SIL, the SIL is the silver miners ETF here, and if you do the SIL-J, that's the junior miners. And again, these have a little bit more leverage than the core large caps themselves. They're buyout targets, that sort of thing, but they're also more volatile, right? But they can be much more profitable. So for example, the SIL-J here in about 2 months went up about 32% here versus the SIL about 25%. So it does put a little bit more octane versus the movement. Two nice ways to do it. And of course, if you look at the ETF and you did the research, you can see the underlying names that make up this ETF, and certainly go look at those charts. So here on my screen, I've got a watch list of names that I maintain. Of course, I do track gold and silver prices themselves. I'll track palladium and platinum as well, the XAU, which is an index. I'll track the GDX, the GDXJ, the SIL, the SIL-J, which we just covered, the GLD, the SLV, the UUP, which is the US Dollar Index ETF. Again, the reason I cover this is because it does have some correlation. And then a handful of individual names, some sector leaders, First Majestic, ticker symbol AG, Wheaton Precious Metals, AEM, Agnico Eagle Mining, Franco-Nevada, IAG, RLG, GFI, BTG, SSRM, and then of course Newmont and Barrick, the big names in the bunch here. And so there's a few names here that you might want to look into, check out the charts, do a little bit more research on these companies. What are their aspects, where do they mine, all that stuff, how much do they produce every year, and so forth. But generally speaking, like I said, I like to just stick to the ETFs themselves and track prices to this, invest in these, and then trade them, day trading with these here individually. Now, one more thing I want to note is the correlation to currencies and some of the economic news. And so last month, the FOMC here in the US had their minutes released here. And so if we go back to that point in time, the price of gold was in a rally, had already had a nice rally up to this point, and then this was in mid-February is when they were going to announce that. So we're looking at this price point here. Now, I had been tracking the price of gold throughout this rally, trading in and out of it, but I noticed that it was approaching this key resistance level, which I showed you guys on that long-term weekly chart. And in conjunction with that, if you looked at some of the technicals here, there was some bearish divergence. You can see the RSI here. Let me zoom in for us here. The RSI was losing some steam here as prices were going higher, and this just happened to correspond with that very important, often market moving meeting. And so I was watching the gold and silver prices here, and while I'm bullish on it longer term, here in the near term I thought it's a little overheated, a little extended. The weekly RSI was pretty high as well. I thought we might have a good chance of seeing a little bit of a pullback here, and so I was timing my entry around the actual FOMC meeting. Now, if we looked at something like the euro-dollar forex pair during that same time frame, I'm going to go back to that time here. This is the very granular look. This is the 5-minute charts on both of these here. On the left is the price of gold itself, 5-minute view, again around that time frame, that February 19th and 20th. And then on the right is the euro-dollar pair, again around that time frame, 5-minute view on both the euro-dollar pair. And you can see there's a very similar trajectory in both of these prices. Price of gold had been rallying during that time frame, topped out here a little bit. You can see the euro-dollar was rallying, topped out a little bit, and of course then there was this pretty quick drop on both the euro and the price of gold after the release of the FOMC minutes. And if we compare the time frames, these peaks and valleys correlate pretty well. So this first peak here on the euro-dollar, this is February 19th at around 1730, 1735 UTC. That translates into this peak right here on the gold price. Then this next peak here on the gold price, February 19th around February 20th, excuse me, at 245 UTC. That's pretty close to this one here. This is 230 UTC. And then this last one here is 11 on the 20th, And you can see that's this one here. The 11th is right there. And then after that, the minutes were released, and we saw a pretty quick drop on both sides here. And so one way that I was playing this was pretty close to resistance. The price had already started to pull in before the minutes were actually released, and then once they were released, it kind of just kicked things off and the price dropped pretty quickly. And there was bouncing, there was some choppy action, but that just kind of really led to a little bit more of a pullback move in the coming days. And the way I traded that here was with the nuggets, or the dust, excuse me, and which was the short inverse of the gold miners. So I was looking for a little bit of a pullback here in the price of gold during this time frame over the next couple of days. I'll pull up the miners here on the right so we can see what that looked like. That's the GDX. And so if we pulled up the gold miners during that time frame, this is again the 5-minute view, so pretty granular look, but here's the peak on the 20th and the subsequent drop. And you can see the miners had a pretty decent drop. I mean, not a major catastrophic drop in 2 days, but certainly had a strong drop here. You can see from the top to the bottom was about a 10% move. And so if we leverage that with the dust here, which is the inverse, keep in mind, so it's going to go upwards and not downwards, you can see that during that same time frame, the dust had a very strong move from the low to the peak, about 34%. So very strong move, nice tradable rally during this couple of days. Looked like it was bottoming out here, and as the minutes came out, they started to rally and just stair-stepped its way higher over the next few days until the GDX hit some support on that other chart. So just a couple of ways to trade it. That's how I will generally use the nugget and the dust. I'll use them as leverage trades to do some day trading intraday. And if I want to do a little bit more of a swing trade, I'll either do the GLD, maybe some options on it, or I'll do the GDX, and you can even do options on the GDX and the GDXJ as well. So just a lot of different options to go here with. Again, just to recap, the 4 major categories, again, physical metal, bullion, if you're looking to go that path. There's futures and options, certainly worth exploring once you have a little bit more experience in the space. There's ETFs, exchange traded funds, on the metals themselves, as well as the mining shares and the ETFs associated with those. So I hope this helped. I hope it makes sense and gives you a little bit of idea of the different ways and aspects you can use to start looking into trading and investing the gold and silver markets. Thanks for watching as always. We'll see you all on the next one. Take care, everyone.